Accounting for inventories. And in this module, we will be learning very important topic, and that is components of the cost of inventory. Cost of inventory, we know that includes material, labor, and overhead cost. Okay. But now, technically, we will see that this includes material purchase cost, okay, cost of purchase of the material, and the cost of conversion. We know very well when we say cost of conversion, this cost of conversion includes the other two elements, labor and overhead. Okay. Along with this, the third point that you can look on the screen, that is the other cost. The cost that we were working out as other direct cost. Okay. So the main cost component in the cost of inventory is the cost of purchase, which is converted into finished goods through the cost of conversion, which includes direct labor cost and factory overhead cost, and the other cost which can be attributed to this total cost in order to bring this inventory into its present location and condition. All right. So present location and condition means that supposedly if the inventory is in process, so this is in the workshop and semi-finished. If it is finished, it is in the warehouse and available for sale. So this is its condition and location. So till that present location and condition, we have to see how much cost has been incurred. That becomes the cost component for that inventory. When we say cost of purchase of an inventory, it in fact includes the purchase price less any discount or rebate or trade discount thing. So that purchase price we get from the invoice minus any discount. All right. The next thing is import duties or the taxes which are not refundable. So those import duties or the taxes which are not refundable become part of the cost of purchase. Look, if we have paid any tax which will be refunded or adjusted in future, that will not be the part of the cost of purchase. Remember this thing. Okay. Then transportation and handling cost. Carriage inward, we have seen this thing. So transportation and handling cost also becomes the part of the cost of purchase. And then any other cost that is directly attributable to acquire that finished goods or material or services. Okay. So any cost that is attributable towards acquisition, towards purchase of that material. Okay. So we will have a practice question on it. In this question, Harun Textile Limited is importing raw material for use in production of goods with the following details. So the amount is in 1,000. The invoice value is 1 million. In a way, 1,000 is 1 million. Custom duty is 150,000. Central excise duty is 50,000. Non-adjustable income tax is 225. Whereas refundable sales tax is 180,000. Carriage that we have paid on this purchase is 40,000, and the commission which is paid to agent for clearance of raw material is 100,000, and we have to calculate cost of purchase of inventory. Let's see over here. the total cost of purchase is 1.565 million. 1,565,000. The thing is that we included this invoice value. Okay, that's fine. Then custom duty, that's fine. Then central excise duty 50, that's fine. Then non-adjustable income tax 225, okay, that's fine. But here there was a refundable sales tax 180. This we will not include over here because it is refundable. We will receive its refund in future. Then carriage inwards, okay, it will be included. And commission that is paid to agent for clearance of raw material. If the agent will not clear this raw material from the port, we will not be able to get this raw material in our factory. So this clearing charges are also included in the cost of purchases of that raw material. So the total is 1.565. The important thing to discuss at this stage is that there are few costs which we do not include in the cost of inventory. These are abnormal production costs. If we have a production that is not up to the mark, that has been lost, so that loss of the cost of production, which is taken as abnormal loss, will be subtracted from the total cost of production so that it should not become the part of inventory and will be taken to the income statement as an abnormal loss. Okay? Or there would be a claim against this loss from the insurance if it is covered under insurance. Then storage cost. We have already discussed that storage of finished goods is not the cost which becomes part of the production cost. But sometimes there is a storage cost which is necessarily to be paid as a part of the process of reforming that raw material or finished goods thing. For example, the storage of rice to make that rice old and then to sell old rice because its price is always different in the market, better than the price which is for the new rice. Okay? So if it is part of the process of production, then its cost will be included. Otherwise, the cost of storage will not be included because what we say that the goods are finished now. And if we are storing the finished goods in our warehouse, that warehousing cost should not be the part of the cost of finished goods. That's the reason. And then administrative overheads and the selling cost, all these are not included in the cost of production. Let's have some very important information about allocation of fixed and variable overheads as well. You see that when we say fixed and variable overhead, it is in fact the factory overhead cost. In an earlier module, we discussed this thing that factory overhead cost can be fixed and can be variable as well. So this fixed factory overhead cost and variable factory overhead cost needs to be allocated to the inventory. Inventory, you know, is our asset. Therefore, the cost that we are allocating to the inventory should not be high. So this is the prudence concept, that if we will put higher portion of the cost in that inventory, might be that would not be recoverable. Therefore, whenever we have to allocate fixed production overhead to the cost of inventories, it should be based on normal capacity of the production facilities. Yes, we can use the actual production capacity that we have attained if it approximates the normal capacity. Okay. But if that actual capacity level is much lower, then that actual capacity level will not be used as a base to allocate fixed factory overhead cost to the inventory. Remember. Whereas in the periods of abnormally high production, the production is very high, then allocate fixed production overhead on actual level, because in that case, the per unit fixed overhead cost will be reduced because the base is very high. Whereas variable production overheads are allocated to each unit of production on the basis of actual use of production facilities. So anyways, we have to be very much careful while allocating the fixed factory overhead cost to the inventory. That should be based upon the normal capacity, whereas if the actual capacity level is abnormally high, then we will use the actual level. Okay. Otherwise, normal capacity would be used as a base to allocate fixed factory overhead cost to the inventory. Whereas variable production overhead cost will be allocated on actual basis. Let's see an example over here, where Jameel Bashir Limited is engaged in manufacturing of surgical instruments. Following data relates to the reporting period ending on 31st December X9. Fixed production overhead is 2 million rupees, whereas variable production overhead is 200 per unit. Material cost per unit is 800 and labor cost per unit is rupees 300. Normal production capacity of the company is 20,000 units per annum, whereas during the year company manufactured 5,000 units. So you see, the normal capacity is greater than the actual level that was attained during the year. Okay, this is the normal capacity, that normally 20,000 units can be produced, whereas in that year we could produce only 5,000 number of units. So there was nil balance of inventory on opening date and the company sold 4,000 units in the year. Okay, production was 5,000 units and company could sell 4,000 units. What does it mean? That we have an inventory of 1,000 units with us. So let's see how this 1,000 number of units will be worked out as to its cost of inventory. So we have two workings with us. One is production cost per unit, calculation of the production cost per unit, and the second one is calculation of inventory cost per unit. Please be attentive. Your attentions are much required, please. So what we see, it is direct material. Okay, in both cases direct material is 800 per unit. It is given over here. Then comes labor cost. It is also direct cost. It is 300 per unit. Okay. So in both cases we'll place over there this. Variable will also be taken as actual. 200 per unit will be the variable overhead cost. So there is no issue with the direct labor cost, direct material cost and factory overhead cost. That remains the same. Remember, we are calculating inventory cost per unit. This is just for the sake of comparison that we are calculating production cost per unit. See, our fixed production overhead is 2 million. If we will divide this 2 million with the actual number of units produced, we will get fixed factory overhead cost per unit produced. Okay. Fixed factory overhead cost 2 million per unit produced is 400 rupees per unit. So in this way, the cost of production per unit comes to 1,700. Whereas, according to International Accounting Standard, the thing is that this fixed production overhead cost should be divided by its normal capacity, which is given over here. 20,000 units is the normal capacity. When we will divide it with its normal capacity, it will give us 100 rupees per unit. So what we are emphasizing, that the cost of inventory should not be higher, so that the question of recoverability of the value of inventory arises. So the cost of inventory should be 1,400 per unit. It is the cost of production per unit, whereas the cost of inventory will be worked out based on this formula, that fixed factory overhead cost will be divided by the normal capacity, because normal capacity is much higher than the actual capacity, so that our per unit cost is lesser than the production cost. So the value of inventory is, for 1,000 number of units, is 1.4 million. How? We will multiply this 1,400 with 1,000 number of units. So this is the practical application of the concept that we discussed over here, where the allocation of fixed production overhead cost should be based on the normal capacity. All right? Well, so the important tips to remember in this module are that cost of inventory includes all the costs that are incurred to bring the inventory in its present location and condition. So those cost components which are required to bring the inventory in its present location and condition will become the part of cost of inventory. Okay? Thank you very much for being very much attentive in this module as well. Thank you.